Asana stock is down something like 75% from its all-time high just a few months ago. Investors are wondering, where is this going to bottom? Geez, this is painful. And so in this video, I'm going to talk about Asana. What do they do? ASAN is the ticker. Talk about the valuation towards the end of this video. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice. And at the time of this video publication, I did not own stock in Asana. ASAN is the ticker. And so what do they do? They're focusing on helping people, employees, companies be productive, with recognizing that when people are at work, the reality is a lot of their time is actually spent talking about work versus actually getting work done. So what this means is having a clear work management tool that makes it easier to see what is the mission that you're working on, what are the actual objectives that you're going to need to do. So it's nice to have a mission, but what do you need to do to accomplish that? What are the specific goals? Who's going to be working on them? What are the tasks? Which teams? So having a clearer line of sight to who's accomplishing what and when, and who's working with whom to get stuff done in various different fields. And so they've, from their research, they've concluded that their work management software tools have resulted in much less emails, much less time on emails, faster to execution. That means getting stuff done faster, and higher employee satisfaction. People are happy to be productive, and ultimately saying the return on investment for their software is quite high, because ultimately this means companies are delivering faster. They talk about sales teams can move quickly to address opportunities faster. And look, it seems like that it's working. You can see significant revenue growth. Now, keep in mind, this is still very early stages for a company. You're talking about, hundreds of millions in revenue. You're not talking about the tens of billions of dollars in revenue. You can see it's gone from 143 million in revenue 2 years ago to 378 million. This is still a relatively small revenue business versus the behemoths, that I occasionally talk about, but they are posting accelerating and hyper growth, from 59% growth last year to 67% growth in their most recent fiscal year. Their fiscal year just ended in January. So you're looking at, very nice year-over-year growth. And it's driven in part by increasing numbers of customers looking to say, hey, we like this. This is a useful tool, growing about 30% year over year, and customers willing to spend more. You talk about dollar-based net revenue retention. And so this is a way of measuring, hey, based on your prior existing customers, are they spending more? Are there more employees that could use this software? Okay, so we roll this out to more employees, effectively more subscriptions, and then, you increase that over time. So for them to call out 120% overall dollar-based net revenue retention, that means even the customers that left, overall, that prior cohort is spending about 20% more. So that is a very attractive, aspect. They're also talking about how some of their larger customers are spending even more. They're really leaning into it. The customer spending greater than $50,000, 145%. Customer spending greater than $5,000, 130%. So really attractive metrics that you're looking at here. And so it's a combination of more customers and the customers they have spending more. But this growth hasn't come without cost. You look at this, and the reality is, in the most recent year, once again ending January 31st, 2022, you're looking at a loss of nearly $300 million. In the most recent quarter, nearly $100 million. So they are leaning into growing this business at a loss. And it's not just, purely, accounting losses. You're actually looking at some cash burn, nearly $100 million in cash burn, in addition to significant, dilution that you're looking at. And you can see how the shares outstanding, diluted shares are up, during this time period. Now, what's interesting here, and this is something that a lot of people have called out, which is like, whoa, have you checked out what this president CEO is doing? Like, look at all these open market purchases. Now, it is part of a 10b5-1 plan, so it's very scheduled. Like, hey, let's just keep buying this period, like in a range of what's reasonable for the stock price. And it seems like, based on this range, that he's been price insensitive to buying shares, which is really interesting to see this dynamic, because it's been buying anywhere from $50 a share to $100 a share. Now, this obviously got a lot of investors, with the FOMO, like, oh my goodness, to the moon. He's buying at $100 a share, and he was buying $70 million. And this is really interesting when you see this. Like, I had no background on Asana prior to this, and you don't see this very often, where you're talking about the top dog at a company literally buying hundreds of millions of dollars on the way up, And on the way down, you can see continuing to buy, $97 million in December at 77 bucks, and you can see $47 million at 63 bucks, all the way down to $50 fairly recently, and layering in another 40 million. So like, where is he getting the money for this? And that's where it is worthwhile to understand a little bit about his background based on Wikipedia here, is that he was one of the co-founders of Facebook. So he has an estimated net worth of $24 billion. So the reality is, between his net worth and his interest in running Asana, he could easily take it private if he wanted to, if the stock dropped enough. I mean, even at the current valuation, if he wanted to take it private, he could. And that's honestly an interesting angle that most companies don't have, and that does provide, I'd argue, a support. So as long as he's interested in running the show there, and he's interested in it entertains him and keeps him, engaged, that is a favorable aspect to consider, just because I'd argue it does provide sort of a safety net. Like, if this drops so significantly, he's going to be like, I'm just going to keep buying the stock. So that is an interesting angle, but we'll talk more about that aspect in just a second. Now, in this channel, I call it Unrivaled Investing for a reason, because I'm looking for exceptional companies that stand out from the competition, that make it, they have a product that is so unique, or, they have something that's special about them that leads to them growing faster than the competition over time. And if you're unrivaled, maybe you have, a couple of different competitors, but, you're growing so much faster that it suggests there's some special sauce, secret sauce that you're using that might warrant continued, hyper growth in the years ahead, or just an attractive return for shareholders. That's sort of, the fundamental thesis that I have working with this channel, Unrivaled Investing, is trying to find these exceptional companies. Because if you are unrivaled, it should warrant this sort of right to win over time. And there's many different ways you can be unrivaled. It can be a brand. It could be, it's through the very traditional competitive advantage types approaches, whether or not it's like low cost, or having a brand, or having some sort of switching effect or network effect. And so when I'm looking at, okay, I don't know a lot about, Asana and their products. I want to learn about their products, and I want to learn about their alternatives. I mean, that's what companies are going to say. The reality is it's fairly easy to quickly see that there are a lot of various different alternatives for, what you're looking at with Asana. I keep seeing the term Monday.com pop up a lot. I keep seeing some of the products from Atlassian pop up as well, Smartsheet. So I'm looking at these different things, and these are all different types of task management, work management tools that are designed to help aid employees be more productive. And so the question is this actually translating into Asana growing much faster than the competition? And so management, calls out saying, hey, we are differentiated. While others are focusing on products for small teams, our strategy is different. Our teams are organized functionally, but most work gets done cross-functionally. And so they're talking about, because they're not just focused on small teams, but they're focused on reducing friction and increasing the impact across the whole organization, that their platform can have greater sort of acceptance within companies, can grow faster, because it's encouraging this cross-team work thanks to our ability to serve as a system of record across different projects. So that's the key term that I keep thinking about. This is a system of record across different projects. Line of sight in terms of, here's the mission, here are the projects, here's who's getting it done, here's responsible for it. So it's not, ambiguous on where these projects lie. It's this person's responsibility to get XYZ done, and they're collaborating with this person from a different department. So they talk about one of our big differentiators, and the key to supporting large complex organizations, the larger the team and more cross-functional the use cases, the faster Asana can expand. So this is saying, look, we are not taking the siloed approach. Oh, we are going to focus on helping the sales force. Oh, we're going to focus on helping the finance team. This is saying this is a tool designed to help across the company. So that way, when the finance team is making projections, they are working with the sales force. They are working with the accounting team. And so you do have this sort of cross-collaboration aspect to make it easier. That's just, a hypothetical example when I'm considering it. But the concern here is that when you start looking at some of these competitors like Monday.com, and maybe I just picked one that's really good, but Monday.com is growing faster, has comparable size, seems to have either comparable or even better growth metrics, and seems like they're managing their cash burn even better. So this is sort of a yellow or red flag to me, sort of saying, yeah, you might be in the early innings of this work management software solution space, but there are real companies that are, doing just as well. And so the question is, could they become sort of bump head to head and make it tougher to sustain hyper growth in the years to come, because you do have, other players in the aquarium that are going to want to suck the air out of it, saying, hey, we want this to ourselves. So that is something, that I consider looking at Monday.com's results. Monday's a public company. And so how should we think about Asana's valuation, especially given that it's sold off so significantly, down, I think, another 23% today, following their fourth quarter calendar 2021 results. And so here it is, they're guiding to 39 to 40% growth rate for the upcoming fiscal year 2023. That is a bit lower than what management, that is a bit lower than I'd argue what Wall Street would expect, seeing a prior acceleration. And it's resulting in, a significant drop in the share price. You've seen the stock drop like nearly 75% from its high just a few months ago. I'd argue, yes, a conservative guidance figure might be a key aspect here, but an even bigger aspect is valuation, and how the valuation got to just astronomical level, 85 times forward sales. That is, you're just in rarefied air. And the reality is, I encourage folks to check out base rates and think about base rates. I have a book somewhere over here. This is the book that I love thinking about, which is Super Forecasting by Philip Tetlock. Highly recommend it. Which the whole premise is you should be thinking about base rates when you're considering various different bets. And the whole premise is, if you're looking at companies, let's say trading at 80 times sales, generally, how do companies fare when you see something like that? And so I look at something like Asana and saw where it traded, and generally that is just such extreme valuation that you are typically going to see a lot of pressure, on, forward returns, just because you have fundamentals and you might have great sales, you might have great underlying fundamental growth, but that valuation, man, that's really, really tough to go through. And, thinking about a range of possibilities, generally, the more rarefied the valuation, the tougher it is, to get a great return. And I'd argue, still looking at it, it's still not, in the crazy cheap, territory. You're looking at nearly 30 times last 12 months sales. And so looking at it now around $37 a share, this is not dirt cheap. This is low teens forward sales multiple. I'm assuming that they grow faster than what management is guiding to, given partly because they accelerated their revenue growth. They were at 60% prior year. This past year, they were at 67%. So I'm saying 40 to 50% growth this next year. I'm assuming long term, they get to 25 to 35% profit margins. That's partly based on saying, look, you have significant, gross margins. You have gross margins of like around 90%. So long term, maybe you do get to scale. Maybe you're able to leverage your R&D efforts and you don't have to spend so much there. Maybe you can leverage your sales and marketing so that way you can get, you don't have to spend as much as a percentage of sales. But once again, that's tough, because if you have so many competitors, you're still going to have to spend a lot on sales and marketing. So that is, it's very much a dance and art to sort of say, okay, here's your gross margin. How can we work to what could be your profit level long term? What could Wall Street investors think? What could a private investor consider paying for this business? So I look at this, I'm thinking 25 to 35% long term profit margins, 15% tax rate, given a good chunk of their business is international. And so looking at this, it's not dirt cheap. It is interesting, this angle with the CEO, Dustin Moskovitz. He could be a wild card here. He's already bought several $100 million worth of stock. He owns over half of the A shares outstanding. I mean, this raises the question of, like, will he treat minority shareholders well? What's sort of this dance here? Would he consider taking the company private and sort of screwing over smaller shareholders, and do sort of like a take under? That's a tough question. I don't know enough of the inside politics and sort of the corporate structure to see if that's, possible for him to do that. I look at Asana, I'm thinking this is early days for the work management space. Not sure who's going to win long term, if there's going to be a winner takes all, or if there's going to be, 5 to 10 different solutions that are all competing, having ultimately lower margins because they're competing, but, growing all alongside each other. I also wonder if there's a possibility that you see someone like Salesforce or Microsoft sort of swoop in and say, hey, we are going to provide this, workforce management tool, and this is going to be cross-sold with our other developments. And you see that's become a core aspect of how Salesforce.com and Microsoft effectively grows their sales, is saying, hey, we're going to leverage this entrenched customer base we already have. And if they were to do something like that, could that put Asana at a competitive disadvantage, long term? That is something to think about. I don't have a strong opinion on that. Once again, this is sort of a quick take looking at Asana. I consider that they still have a full valuation, even though insane that it's down 75%. I think that does reflect, yes, trading at, let's say, forward times, forward teen sales is a full valuation. And me saying that, even though it's down 75%, just reflects how nutty the previous valuation was at like 80 times sales. That was just full froth. People foaming at the mouth. Oh, I gotta own some Asana. Like the CEO's buying it. I just like that. That is just kooky dukes. Looking at that to me, and that's why I'm looking at this. And I think it certainly could go lower in the short term. As I think about, has this potentially bottomed? But I think look, ultimately they are growing very significantly, and if the stock is going to have a good run from here, they're going to need to prove, one, continued hyper growth, let's say 30 to 40% annualized growth in the years ahead. If they can do faster than 40% annualized, I'd say the stock could have even more significant upside, could have a lot of upside. So that is a question mark. Can they do it? And a second key aspect is, can they ultimately prove and start to show that they get some operating profit? Because that is a core aspect of valuing this business, when the reality is they are significantly unprofitable right now. So assuming they do on both of these things, which is a huge if, that is a big, big, big if, one could see potential upside of 150% plus, maybe more if they compound at greater than 40%. I do not have enough of an insight here to say, oh, here's why they're going to do this. Now, keep in mind, this is a hypothetical framework. Stock price can go way higher or lower. A lot depends on the execution by management. Effectively, will they deliver on 40% or will it be closer to 30%? And the sentiment. As I look at this, I think, look, day to day, stock price can go anywhere. I think, looking at a low teens forward sales, multiple, I think, look, if the stock were to drop to like 5 times sales, that's possible. So you could have a lot of short-term heartburn. But thinking about this over a long-term perspective, over, let's say, 5 years, if the company stays public and they're still growing at 30, 35%, and they start getting towards, let's say, start indicating that they could easily hit that 25% profit margin, figure that I penciled out. If you could do something like that, then I'd argue at the current price, you probably do have some support. That's what I would think, looking at this. Also, given the fact that you see the CEO, he was buying a ton of stock at much higher prices. So, I look at this and I think, I'm not going to say like it's officially bottom. No, I think, when you're dealing with valuation, you could also swing well to the other side, and it can easily drop to, let's say, it can easily drop from like 13 times forward sales to like 5 times forward sales. So that would cause a lot of near-term pain. But longer term, at the current price, if they continue to execute, you could see the price just stay flat or stay in a range, but ultimately the valuation just keeps going down because the fundamentals, keep improving. If you're growing 30% a year and the stock price, staying flat, that valuation keeps coming down to a more and more reasonable level. So that's how I'm thinking about Asana, looking at their results. I'm curious about it. I don't have a strong opinion about it, just given that it seems like there's so many different work management tools out there. If you have, opinion about Asana, or you use some of their tools, would absolutely love, to hear your thoughts. I'll definitely continue the conversation on our exclusive Unrivaled Investing server, just to ask the Unrivaled Nation, if any of them are using the tools there. And if you're interested in joining a community of investors looking to learn and try to find exceptional companies, try to find those potential multi-baggers, check out unrivaledinvesting.com. Click join the journey. I post on a regular basis. We're interacting on a regular basis. And if this video has been helpful for you, talking about Asana, ASAN, please make a point of hitting that thumbs up, hit that subscribe button, and thank you so much for tuning in.